Good morning, good afternoon, and good evening, everyone, and welcome back to Commodity Trading Week. My name's Dipesh Patel, editor at Trade Finance Global and also host of the podcast Trade Finance Talks. And today we're talking about the current state of trade finance in the commodities markets and what might be in stock for the next 12 months or so. But I guess taking a look back at the past 2 years, we've seen a huge shakeup in commodity trade finance. And despite the pandemic, numerous frauds, and probably some incompetence in the market, trade must keep flowing and commodities need to be financed. I think the largest trend we've seen has probably been the exiting of large trade banks like ABN AMRO, or at least many banks have reduced their exposure to the sector. Now, recent research, according to TXF, suggests that 50% of corporates are using alternative sources of debt to raise capital now. And of the banks that are funding commodities, there's definitely been an increased tightening of deals in the market, a reduction of lending on revolving credit facilities, for example, and a decreased risk appetite. But on the other hand, volatility is good for some, and for some of the largest commodity traders with big balance sheets, profits were considerably up versus pre-pandemic levels. So what does this mean for commodity trade finance as we look towards post-pandemic recovery? And what about the huge rise in alternative finance? Can it plug the gap, or is it just too expensive money? Regulation, of course, is here to stay, but can tech simplify processes, operations, and due diligence? And what about the massive shift towards sustainability? Customers and corporates are demanding transparency in supply chains as well as resilience. But is there room for ESG in commodity trade finance, or is this just another fancy PR stunt? So with that in mind, I'm delighted to welcome my terrific panel, Dr. Sardar Abdul Rashid, a commodity risk expert, Janan Tulum, Head of Treasury and Trade Finance at Petroineos Trading, and Tom James, CEO and CIO at TradeFlow Capital Management. So welcome back to ComRisk and welcome to this panel session.
Thank you, Dipesh.
Thank you.
So to start off with, I'll do, I guess, my famous elevator pitch. So I'm going to ask you guys in no more than 30 seconds or so, who are you, where are you from, and what do you do? Sardar, let's start with you.
Yeah, myself, Dr. Sardar. I work for the commodity risk industry from a couple of years. I cover mainly the different segments, especially the agriculture, energy, and metals. So currently, I'm associated in GCC country. I'm looking for after as a director commodity risk with a Savola Foods company. That's all about me. Looking forward. Thank you, Dipesh. Back to you.
Janan, over to you.
Thank you. My name is Janan Tulum. I am heading Treasury and Trade Finance facilities at Petroineos Trading Limited, which is a joint venture company between PetroChina International London and Ineos Group. We have two refineries. One is in Grangemouth, the other one is in Lavera. So we supply crude to these refineries and sell oil products, as well as trading with the third parties in the market as a company. Thank you. That's all.
And Tom, over to you.
Yeah, hi. So I'm Tom James, CEO, CIO of TradeFlow Capital. We're an alternative trade finance fund management group, basically enabling trade. So we're a non-lending company. My background, 30 years in physical commodity trading, risk management. Yeah, we've been around now for 5 years.
Thank you very much, all, and a great diverse panel here from lots of different backgrounds. So let's start with a bit of an overview on commodity trade finance and commodity trading in general. Janan, it's been a bit of a bullish year so far, right? With increased oil prices, high trade volumes for, say, sugar, corn, soy. Has this benefited traders?
Yeah, thank you for the question. I believe as a trader, if you know how to read the market, regardless of prices low or high, as long as there is a trading volume, this is beneficial for you, because when the prices are low, there is always a kind of inventory positioning opportunities. To be successful, I think, in the market, you need to be present in so many different markets, not just focus on one area, and so chase so many arbitrage opportunities, price optimization, even time to time, credit opportunities can generate extremely good trading margins for the traders. So, as I said, it depends on the trading, how you read the markets and your concentration on different markets.
Thanks, Canan. Sardar, what's the biggest challenges in the commodity markets right now when it comes to access to trade finance? And as I mentioned earlier, we've seen exits, fraud, we've also seen digitalisation and opportunities. And I guess looking at that from both the corporate and the lender perspective.
Thank you, Divesh. It's very important that the commodity trade flow should continue. And that we have a very diverse market from east to west and north to south. It's a wide market, so we need the commodity from one place to another. That is the inevitable of the living livelihood. The coming into the commodity trade structured finance, especially concerned, the biggest challenge we are facing is that sanction regimes. Okay, the sanctions are very important because once or you enter into a contract with somebody and one fine day morning you are getting another news from that the sanctions are enforced, it will affect your value chain. That is the biggest thing. And another is anti-money laundering directives. There are a lot of countries are more activating the fifth directive. Fourth directive is already in action. And this fifth directive has a lot of regulations that is affecting the source country as well as the delivering country. That is, for a financial intermediary is concerned, it is a big challenge for a new intermediary to get into and find immediate actions related to these challenges. Another one important thing is regarding the liable. We have seen the Brexit and the movements are happening. So currently the market is looking for a sterling risk-free reference rate mechanism. That is another challenge we are going to face. That's why a lot of big deals are stopping and we don't know what will going forward. And the Brexit is one of the issue we are facing, especially if you're concerned with the European markets and the trade movements on financing movements and mobilization from that part of the world. But in GCC is concerned, sanctions are very important because we are neighboring countries, Iran, and we need to deal with them. And we have other countries like Syria, and people are leaving, especially the agricultural commodities are concerned. We need to move the commodity from one place to another. It is a livelihood question mark. So these are the biggest challenges. And the pandemic has another challenge that is a geopolitical as well as a natural calamity, you can say. Even it's big challenging area to get into the trade finance market, especially trade houses dealing with food business is concerned. I think this is my opinion on that. It's up to you, the panel. Thank you, Divesh.
Yeah, for sure, LIBOR and term rates, compounded rates, etc., have really been at the front of mind for I guess thinner margin commodity traders. Canan, when it comes to sanctions, I know you're nodding. How's that affected your business at Petroineos?
I wouldn't say it's specifically affecting our business, but as Sardar mentioned, this is a kind of global challenge for corporates and also for the banks. It's just because everyone is kind of quite we don't know, the banks, they are quite conservative when it comes to sanction countries. So you show a deal, and then there are even though that's not a sanction, there are so many questions from the banks which delay payments for both yourself or for your buyer or for your seller. Doesn't mean it's actually hitting any sanction, but just everyone is just so scared and so cautious. Especially we are dealing with counterparties, we sell FOB, but we don't know where the cargo is going. But then in the end, it might end up in a sanction-related country, which kind of affects your position as well. So this is, I would say, this is one of the biggest concern. And also we need to add fraud as well, especially with working from home. There are, so many creative ways of fraud we have seen in the markets, like, fraud companies creating so many domains, communicating between different companies is extremely biggest challenge, I would say.
Yeah, absolutely. Couldn't agree more. Tom, has the pandemic driven up the cost of capital, and what's the knock-on effect for producers and traders?
That's an interesting question, because it's, I guess it's the same sort of thing, but it's not so much the cost, but I think returns expectation of investors has been driven up, certainly since Q4 last, because we've seen so many other asset classes like the stock market and equities, going through the roof, and then a few of them dabbling in crypto as well. So until recently, that was looking good. So a lot of them have come to the table, sort of saying, well, I want to see double-digit numbers, mid-teens returns, etc., when that's the kind of thing we've not, as we don't lend money, but we're taking full ownership, true security and ownership of the cargo, and sometimes even chartering the ships, so we control the logistics. We didn't have to increase our pricing per se during the COVID period, because we weren't really taking any more risk, because we weren't taking direct credit risk. There were some extra costs here and there, but that was usually because of just some delays, sometimes at ports for loading or discharge of the cargoes or something like that. But certainly, so those costs haven't changed, but certainly the investor expectations, I think, has been pushed up quite a bit, certainly into the low to mid-teens generally. I think also there's a bit of confusion from investors, and it's been great that this conference has been able to address some of those issues around the trade finance asset class, because it's such a broad spectrum. You've got at one end invoice factoring, invoice financing, and trade receivable financing at one end, and then you've got the other sort of trade finance, which is richly getting the funding that 80 to 90% of deals need just to happen and physically move a cargo around the world. I would just add to say that for producers and traders, we'd have to say, well, if you're a big trader, perhaps you've had slightly less impact, or felt less impact. But if you're an SME, which is what our focus is, guys who have less than sort of $500 million turnover, you've definitely seen not just the cost of capital, but the availability of capital for trade finance drying up a bit.
Yeah, absolutely. And I guess the kind of short-term self-liquidating nature of trade finance does make it an attractive asset class for investors, but there's potentially still not a great understanding of the complexities and nuances of this asset class, which still makes it difficult for new market practitioners entering into this market. Canan, does the price volatility of the underlying commodities themselves affect trade finance?
Yeah, sure. Thank you. Surely it does. Because in the end, as a company, we have like certain lines in place with the banks. We say, okay, our line is for 300 million, and when the oil price is kind of low, for crude $30 per barrel, you finance 10 transactions. But when it comes to 60, then immediately, it's reduced. It kind of puts pressure on your line availability. So this is, one angle. The other angle is some companies, they need to put some sort of margin or collateral, especially with fixed price deals. And then, if there's a difference between purchase and sales in terms of pricing. So, when the prices goes up significantly, this margin requirement and collateral requirements put additional pressure to the trading companies. But for producers, I would say, they benefit from high oil prices because, for them, their working capital need reduces significantly. So.
And just to add to Janan, just the point, Dipesh, it's regarding basically the cost of hedging is increasing because the market volatility is increasing. You need to fund for your margins. So that is additional burden for the trade finance companies, because normally the trade finance mechanism, the title deal will be hedging the instrument, because if you're financing, you will take the custodian of the undertaking and you will be hedging yourself. That will be an additional cost. So the cost of hedging is increasing in terms of the volatility increase. Obviously, that's the one point.
Yeah, absolutely. And I guess talking about the actual structures themselves, Tom, has there been a surge of utilization of perhaps other structures, and how can companies provide alternative finance to facilitate trade?
Yeah, I wish there had been a surge. I think it's a bit of a slow trickle, but we're definitely seeing, I think, some great opportunities. I mean, there are quite a few very well-established trade finance funds out there who are lenders, and banks, of course, who are doing traditional lending in trade finance. And I think we're starting to see now, banks, who first hit sort of with Basel II, Basel III. Now we've got the prospect of Basel IV regulations coming in. They're starting over the last few years, just before COVID, seem to be accepting the fact that they're not always the right place to hold the collateral, to hold the commodity, due to unfortunately, reducing credit risk offset capability there on their own books. So, alternative trade finance funds like ourselves can step in perhaps as a better place to hold that commodity asset. And we go one step further to actually not only hold it, but actually monitor it and track it with technology as well, so that if anything goes wrong, we can actually help dispose of that. And certainly last year, that was, I think, another area where companies like ours in the alternative finance space, who have in-house expertise around physical commodities, we can also give the banks comfort that if anything does go wrong, they have someone, a neutral principal, someone who is aligned with them to actually, in an organized and orderly manner, dispose of that asset. So last year we were helping some banks get rid of, they suddenly became owners of some products to try to dispose of that and get the money they'd lent back as well. So I think there's a lot of collaborative stuff that's come out of COVID. And that's obviously something we really want to see much more of, is working with banks. Sometimes we can work as a first loss position and transform their risk position and just make it actually, hopefully on a blended rate, going back to your question about cost, hopefully on a blended rate, actually bring down the overall cost to commodity traders.
No, absolutely, and we'll go into a bit more detail on that, because I think it's a good topic there, and I encourage anyone to ask any questions. Feel free to privately message in the chat, and I can pass the questions on to the relevant panel member. But let's talk a bit more about those sources of capital and collaboration. And Janan, have you seen a bit of a liquidity diversification in the market?
I believe we have. I mean, from our side, to be honest, because we are kind of, if we kind of separate the market to kind of major players and non-major players, I believe, major players, they haven't been affected so much with this kind of some of the banks leaving the market from a capital diversity perspective. But we see some of our counterparties, they used to maybe work much more closely with the banks who recently exit the market, but now we see so many local banks. so many Italian banks, so many Swiss banks from Switzerland, local banks, Spanish, from Germany. These banks, these local banks, kind of, we notice, are replacing the global banks who used to be taking big part in this business before. So I think this is the biggest change, I would say, which is kind of affecting everyone, and we will see the impacts in the future.
Yeah, absolutely. I mean, I think I was reading this morning that traffic areas profits were up 2.1 billion for the first half of their financial year, up half a billion from the previous time period before that. Tom, let's talk about banks and non-bank funders. How can they potentially work together to collaborate? And I guess TradeFlow Capital's fits in nicely here.
Yeah, I mean, you know, we fit in nicely. Also, other alternative trade finance funds fit in nicely in terms of, I think, again, helping to change the credit risk profile of transactions for banks. Because, I mean, after all, banks want to lend, but, you know, the liquidity is kind of stuck there due to various regulations, etc., and also just the increased costs, going back to what Dr. Sadeh was saying in terms of KYC, AML costs. A lot of the time, banks turn down the smaller transactions for SMEs because it's just not a profitable transaction. Not that it's not a good transaction, but you know, it just costs a lot to process it. So that's where, hopefully, with you know, for example, we've digitized a lot of that KYC ML process, as others are doing, to try to speed that up, also make it more efficient and more effective and more real-time monitoring of ongoing KYC AML in case anything changes in the status of owners or directors of firms around embargoes, etc. So we can kind of help de-risk and act as a buffer to the traditional bank lenders. So hopefully that, you know, as I said before, you know, we're starting to see a bit more collaboration around these areas, and banks accepting that, okay, you know, alternative trade finance funds have a role, a collaborative role in the ecosystem.
Yeah, no, absolutely. And well, I guess it comes down to risk and potentially even ownership and looking into those structures. And I got a question from Tony Brown. I guess this is good friend Tony Brown. Do you see a role of trade financiers to finance commodities by taking ownership of the products themselves as a principal rather than as an agent of the buyer or supplier? And Tom, I'm going to ask you that question.
My answer will be biased because that's exactly what we do. It's, you know, we don't lend money, we take full ownership of it. We are exposed to market price risk potentially in the event of a default, which of course thankfully is very rare in the sort of bulk commodity space. But I think that's where, you know, we can really help, hopefully, help the banks unlock more, you know, by holding the commodity and monitoring and taking that kind of first loss position. But it does mean there's a lot of extra paperwork, and that's where what we do is only scalable thanks to digitization. But you know, we've still got a lot. The industry's got a long way to go. We did see, I think, unfortunately, still only 1% of bills of lading, the ownership docs for cargoes, are electronic still in the world, despite the problems during COVID when you know, your DHL, FedEx couriers could not move around easily. So I think that's probably the key thing that will help more companies like us develop is you know, as digitization of trade is steadily increased.
No, absolutely. 1% of e-bills of lading actually used, and 99% of our articles talking about bills of lading are about e-bills of lading. So perhaps there's an issue there. Let's go back to the banks and a question from Renner. Right now, the big banks are exiting. What would make them come back? And Janan, I'm going to ask you that question, and potentially also we can segue into what's the role of some of the local banks here versus those global banks.
Yeah, I believe digitalization and kind of might help. Like, I'm quite hopeful about blockchain, and which is kind of the banks. They need some sort of comfort to be able to, to make sure that they will mitigate their risks. As I said, like blockchain, the banks, they are kind of comfortable with the risk they are taking, and they feel like they are fully in control. This might be the only way they will come back. Otherwise, it's too risky. It's I understand where the banks are coming from, why this is extremely challenging for them. Especially with oil financing, because of the dynamic of the transactions. Like, everything is copies of contracts, copies of bill of lading, letter of indemnity. Letter of indemnity is a very important product for us, and for the banks, it's just a paper, can be issued easily. But as I said, I think with the digitalization, with electronic BL, where they can feel much more comfortable, after that point, they will start coming back to business.
Thank you very much.
I believe future is digitalization.
Great, and yeah,
for trade finance.
We'll go into a session about fintech straight after this. But actually, Sadat, I'm going to ask you the exam question, which is and leading to Rafael's question: how do you see the trade finance landscape in financing for small trading houses or startups? Does trade finance favor the big players right now?
Because it's a tricky question, basically. It depends on the trade finance companies, basically. If the startup is more struggling, they have a lot of issues. If you're concerned with approaching a financial intermediary, they will ask for a history and KYC process, and it is very difficult for them. But it is giving an opportunity if, as Tom mentioned before, there are a lot of funds are coming into the picture, either a joint ventures or the funds. They will look into the business model, and they will see the KYC process is a little bit on a case-by-case basis, and they're ready to fund them. Because as you come into a commercial backup of trade financing from an international bank, for them, they have set of rules, and they are regulated by the regional regulatory regulations, centralized regulations, internal controls. So they are tied up, so that the opportunities are less. But at the same time, we have this kind of funds are coming up, especially the trade financing funds and joint ventures are coming up. They are looking more on the profitability of the business. It's a win-win scenario, as well as for the fund, as well as for the customers. So that's an opportunity. That is an encouraging thing, that there are a lot of funds, especially based in Singapore and Rotterdam. These are the commodity hubs. They're coming up with a lot of funds, innovative funds and innovative structured products that will cater this kind of gap, I believe.
Thanks very much. And now let's talk about, I guess, the digitalization, the fintech angle here. And I'll make a shameless plug. Myself and Emmanuel Gan at the WTA recently published a white paper called Digitalization as a tool to accelerate MSME access to trade finance. And I guess we kind of highlighted the 6 or 7 different technologies and how they could impact various elements of the trade cycle, but perhaps might be worth a read. But Janan, what is driving fintech collaboration in the markets? And sometimes I hear actually the problem is Basel, but what's driving the fintech collaboration? Is it consumer driven, so people demanding transparent supply chains, or is it driven by those potential operational efficiencies, cost cutting, driving up margins, etc.?
Sorry, your question is from a fintech perspective or from corporate perspective?
Oh, good point. Let's take it from a corporate perspective.
I think from corporate and from maybe again from lender perspective, the speed and transparency, easy access to information at one go is the kind of drive for us to work with fintech companies. And I believe it's the same for for the banks and fintechs. They know their product, and they know the market, and if they have experience from corporate side as well as from banking side, and then if they collaborate this information with the fintech. This will be kind of they can produce solutions for trade finance needs.
No, thank you, Tom. Tom, what's your view? Because I guess you have the benefit of being able to speak to both sides, both parties here, to the banks and the lenders and the corporates.
Yeah, I mean, I think that the biggest issue when we first studied the problem for SMEs, why banks couldn't lend to them and why they couldn't borrow, I think ultimately we keep coming back to the same thing: a lack of data and transparency. And so we've spent a couple of years before we could launch our first fund in 2018, really looking at how we could digitize a lot of the big headache processes. So the KYC AML stuff, which I should say is to bank or exceeding bank requirements in terms of KYC AML, but just done digitally. So as least painful as possible for the SME, but and also real-time checking to help keep up with changes, the rapidly changing, sometimes embargo and other scenarios that are going on in the world. So that's, and then trying to digitize the information and scorecard not only the counterparty who's an SME, which can be awfully difficult, but then also scorecard the transactions themselves, the underlying transactions. So sort of really to try to take a greater interest in the underlying trade and perhaps less interest in the counterparty itself, because the reason why they're maybe not being able to get funding is because they don't have a 3-year audited track record. But the principals who've put all their family savings into the business have been in the business for 20, 30 years. So, I think it's trying to really look more deeply into the qualitative data as well, and not just the quantitative data, which sometimes, well, as we've seen with some of the problems that some of the banks have been hit with last year, came about really not, on the face of it, looks like they were just doing balance sheet lending. They weren't really doing trade finance and really understanding or monitoring the underlying physical flows of the commodities that much.
Yeah, absolutely. I'm going to go a bit off piece because we've got so many questions here. I really want to address some of the questions from the audience to the panel. A question from Elaine Kimberley, and we'll kind of slowly segue into ESG and sustainability. But what needs to happen in trade finance and commodity trading to build real momentum for digital supply chains? And will it be coupled with sustainability and decarbonization? I'm also just going to bring into that the fact that on Juan's point, commodity trade flows come mostly from conflicted markets such as crude oil. Who would like to take that one?
Please, Doctor, go ahead.
Yeah, the sustainability point of view, as you said, we are living in a renewable energy world, and we are trading C4 credits, and we are going into more sustainability. And especially the biggest question is who should initiate it? Is it the trade finance or the companies? So what I believe is it should be a mixed approach, because looking forward to after 2040, that we know it's already forecasted that almost 50% of the fuel vehicles will translate it into electronic vehicles. So that's a huge amount. then we need to make amendments from now itself to change the commodity trade finance more aligned to the sustainable energy side rather than on more fossil fuel. And it should start from the digitalization process. But if particularly looking into the digitalization and the clubbing into the future market, because our panel, one of the topic is beyond 2021 and beyond, is more on a governance path. The governance path is lacking and leadership is lacking in this area. So that need to come from a bank perspective, because all the transactions are going through by the financial intermediaries. So it should come from the financial intermediaries. As Dipesh mentioned, is it the Basel? Is again a stumbling block for the digitalization? Or we need to bring a new person or a new entity in a global leadership, because the trade is a global thing. We are moving one commodity from another through a value chain. So it is not a sectoral business, it's a global business. So we need someone like we do in grain commodities. There is a GAFTA, there is a oil commodities, there is phosphor, there is a logistical wise P&I club. So some kind of leadership need to be come up to take over this digitalization process forward. Yeah.
Thank you. Tom, did you want to add to that?
No, it was just, during COVID situation, we thought, okay, this is it. Everyone's going to go digital and ditch paper. And what was surprising as to what, into the question as to what needs to happen. I totally agree with Dr. Sadeh's comments that there needs to be leadership. I mean, I think we do have leadership. We've got the International Chamber of Commerce with its digital standards initiatives, which is great. They did the Incoterms, and they're working on digital standards and working with all the other all commercial bodies as well around that. But what was interesting was Peru in South America. They were the one government that stuck their neck out and said, okay, guys, you have 6 months to go digital, otherwise you're not going to be able to import or export anything. And that was it. Everyone went digital. So there has to be also a bit of pressure there. It was quite a gutsy move by Peru to do that. But I think also the other thing is when we look at digitization and fintech, so far, the big buzzword has been disintermediation, trying to do things cheaper. I don't think most people are bothered whether it's cheaper. They just want it to be more efficient and faster. Because if you're an SME and you're still being charged the same amount to process your trade through BLs or whatever, but you're able to actually use that same capital 3-4 times each month instead of just once, there's a benefit there. So I think the main thing is actually that movement of capital, the velocity of capital, as I've heard it described, which rather than just saving money through digitization. So I think also people have to think about making sure that all these people that are involved in the supply chain are still able to make a living and not suddenly just cut out of it. And I think that may have been something that's holding the adoption of digitalization. Ships make money by issuing BLs. Well, they don't get paid by anyone to issue an electronic BL. So pay the ships. Let them make sure they're paid for issuing a digital BL. We'll probably find that goes from 1% to 10% in a year adoption rate. But that's just what I've observed anyway.
No, absolutely. And also we've seen some advances, I guess, from a legal perspective, the adoption of the UNCITRAL MLETR in obviously in Bahrain and Singapore, and hopefully, fingers crossed, soon to be UK, Abu Dhabi, Paraguay, and Egypt to follow suit. Janan, in terms of, I guess, adopting various digitalization techniques into your process, can you give any examples of things you're doing at Petro Ineos or that the company are doing at the moment to try and digitize some of their prospects? And where do you see the most benefit? I know you mentioned blockchain earlier as potential.
Yeah, we're working on blockchain, I would say, for our operations, shipping operations, and also for our trade finance trade finance activities. And for us, from trade finance perspective, the biggest benefit will be the speed response and recording. Everything is kind of if you like to check the data, everything will be in one software. And instant communication with so many banks and also with your counterparties, immediately. These are the benefits, and also I would say this is the biggest benefit for us, and also it's kind of paperless as well. I mean, I think that, as I said, this is the way going forward for us, the blockchain, we support it heavily.
Yeah, absolutely. Thank you very much. Very conscious of time. We've got 5 minutes left, so I'm going to finish off with one final question to the panelists, and I guess alluding to the title of this presentation. But as we look towards a roadmap, potentially, hopefully, an economic recovery, and also a health recovery out of the pandemic, and potentially some stability in the markets, what are you looking forward to? / what needs to be done or prioritized over the next 12 months when it comes to commodity trade finance? And Sadar, I'll start with you.
See, this COVID-19 was exposed already. There is a funding gap, right? And it exposed the supply chain vulnerabilities we are facing now. So there's a great opportunity for the new ventures or the new investors to come into the picture, either way of commodity trade financing or angel investing, or these kind of ways, because we are exposed to every way in look and corner and the vulnerabilities. So it's a weak point is exposed. So the investors can look into it, and they can fill up the gap looking forward. And this is an opportunity for them, because COVID is a pandemic, but at the same time, we have to remember it's an opportunity for a lot of businesses. We have seen it, and we are seeing it. That's why we require a collaborative approach from considering all over the stakeholders. Thank you, Dipesh.
Thanks. Tom?
Yeah, I mean, investors, we had 10 times more business that we could support with our AUM. In 2020, we doubled our AUM during COVID. We now have 30 times more business than we can finance and invest in. So investors. I think the one thing, though, going back to what we're discussing in terms of structurally how maybe governments or supranationals can support the recovery post-COVID, and SMEs, which contribute a lot to new job growth usually in most countries, is help support collaborative financing between alternative trade finance funds and banks, and give us, the alternative trade finance funds, I speak for all of them, not just our own, give us access also to some of the sort of guarantee support and that you give to banks, because we're involved in a lot of transactions which are just not profitable for banks to get involved in, with or without ADB or IFC guarantees, etc., etc. So just see how you can work with the the sort of the non-financial institutions that are coming into this market.
Thanks, Tom. And Janan, over to you.
Yeah, I think I would say again from this digitalization, if we put more efforts on the digitalization, I think this will add huge value to trade finance going forward. But I forgot to add before, on the previous question, that the challenge we see, there are so many different products, and so many, every institution is kind of promoting their own product. So I think if they come together and try to concentrate on one, for example, one trade finance product for blockchain, one for operations, rather than so many different options, I think this will be extremely beneficial for the market, because when you try to introduce the fintech you are working on to a bank, they say, oh, but we use this one. It's kind of, I think this is kind of slowing the process, and I'm hoping that the institutions, they will find a solution and work on, something which will be beneficial for everyone.
Yeah, no, absolutely. I'm afraid that's all we've got time for. I think 3 words there: collaboration, investors, and digitalization are probably the key words from there. Sadar, Tom, Janan, thank you very much for joining us on ComRisk.